Hey guys, welcome back to another video. Today I wanted to talk about 3 ways you can reduce your taxable income in trading in order to save more money, because obviously the more money you make, the more the government is going to tax you and the higher your tax bracket will be. But before we begin, I wanted to preface with saying that I'm not a tax professional, nor should you take what I say as professional tax advice. I'm merely sharing with you the experiences that I've learned over the course of my trading career when it comes to trading and taxes, which I know can sometimes get complex. So I wanted to simplify the explanations to these 3 ways in the best way I can. Without further ado, let's get started. The first way you can reduce your taxable income is using mark-to-market accounting. Mark-to-market accounting is basically where the stock you own gets realized at its fair market value at the end of that tax year and considered sold, regardless if you actually sold that stock or not, causing that gain or loss to be taken into account for that tax year. So, as you may know or may not know, if you're classified as a regular investor, you can only deduct $3,000 of your total losses before it gets carried forward to the next tax year. For example, say if you bought a stock in a given tax year, things didn't go your way and you ended up with a $6,000 loss from that stock after selling it. You can only deduct up to $3,000 towards your taxable income for that year, and the remaining $3,000 gets carried over to the year after. But under the mark-to-market accounting method, you can deduct the entire $6,000 from your taxable income. This is a huge benefit as a trader. So say if you're day trading and you have a $100,000 gain and a $40,000 loss, your net gain would be $60,000 for the entire year, and that would go towards your taxable income instead of the $97,000 if you weren't under the mark-to-market. Because again, you can only deduct a $3,000 loss per given tax year, $100,000 minus the $3,000, whereas you can deduct your entire loss under mark-to-market. Another benefit of mark-to-market is that the wash sale rule does not apply to you. The wash sale rule basically means if you buy a stock and then sell it for a loss, but then you immediately buy that stock again, so the loss you incurred previously cannot be deductible towards your taxable income under the IRS. But again, the rule doesn't apply to you under mark-to-market since you're considered a trader. Speaking of which, you need to prove to the IRS that you are eligible for mark-to-market. It's not something you can just simply choose anytime you want. They look at your 1099 and take into account certain requirements like the amount of trading you're doing. If you're consistently day trading and treat it like a business, you are most likely eligible for mark-to-market accounting. One of the downfalls of mark-to-market, though, is that if you have a large unrealized gain at the end of the year, meaning you haven't sold that stock yet, that stock will basically be considered sold, at least unofficially, and that's basically going to increase your taxable income. So again, just something to consider. The second way you can reduce your taxable income is to trade in a traditional or Roth IRA account as opposed to a regular savings account. By doing this, any gains you earn for that tax year will not go towards your taxable income, at least not until you withdraw that money under a traditional IRA, because obviously with the Roth IRA, your money is tax-free when you withdraw it since you pay the taxes on that contribution before you put it into the retirement account. And vice versa, any losses you incur in the IRA account cannot be deducted from your taxable income for that year. One downfall of trading in a retirement account is that you're not able to use margin, so you're not going to have that much buying power. You can only trade with the cash you have in that retirement account, and because it's a cash account, the settlement period has to be 2 days before you can trade with that cash again, whereas you can trade anytime under a margin account. But once again, a margin account is not possible with a retirement account, so definitely something to consider. The last way you can reduce your taxable income in trading is to write off any business expenses. Treat your trading like an actual trading business. If trading is something you do relentlessly, think of the things you spent money on to create that business. What do you use every day for your trading? Internet, your computer, perhaps very expensive trading softwares to improve your trading. All of these could be used as business expenses to reduce your taxable income. So you just have to think long and hard and make a list of things you paid for that went directly towards your trading business. Again, definitely talk to your accountant about this and they could walk you through what you can actually deduct. And so hopefully that's something that could give you guys a bit more guidance. I hope you guys found this video helpful and that it provided a bit more clarity in the ever complicated tax world. If you did, go ahead and hit that like button and consider subscribing to this channel to get more videos like this one in the future. Other than that, I thank you for your time and hope you guys have a great rest of your week. Take care.